Hi, Larry Berman here, back in the office. So excited to get away from the work from home, as fun as that is. I've actually been working from home for the better part of a decade in most mornings, and I'd come into the office in the afternoons. But here we are, Friday afternoon. I'm in the office, had to do a couple of things this week. So what's on my radar this week? Every Wall Street firm is falling all over themselves to see who can now make a more hawkish call on how tight the central bank's going to be. From my lens, my humble lens here as a fixed income strategist for the vast majority of my career as a Fed watcher and watching the bond market and the yield curve, there's not a snowball's chance we're getting to 3% on the funds rate. Well before that, the equity markets are going to go into spasm and the economy is going to have a bad response. So it's just amazing how really smart, educated people think that they're going to fight this inflation by raising rates that's supply side driven, not demand side. There's a debate to be had here, but Mohamed Al-Arian had come out and he basically, rational thinking, said they should do less. They should let inflation run a little bit here, because if they tighten too much, they're going to put us in a recession. And I wholeheartedly believe that. So when does the equity market get that? Right now, Wall Street's pushing the narrative that you got to get into stocks as an inflation hedge. And oh my God. So this is, wow. So let's now take a look into the chart room and see what the bond charts are telling us, because I think bond investors are a lot smarter on what's going on in the economy than stock investors. So here we have our long-term bond ETF, TLT, and a look at the last 5 years here or so. And you can see the last time bonds were weak, bond yields were high, was back in the 2018 tightening cycle. Now what the Wall Street is telling us is that we're going to get back to a funds rate close to what we saw in 2018. And that puts the long bond north of 3%. Let's zoom in here and have a closer look. So here's our trend channel here. And you know what I'm seeing is a technical break here in oversold markets, absolutely. You've got parts of the yield curve inverting already in the middle part. That's largely very, very technical. But here's what I see. I see far more equity market risk to higher interest rates and profit margins. And I see the long bond here as an attractive hedge for a rally back, maybe not to the 140 level, but certainly 135 here. So under 130, there's a tradable rally here in the long end as a bit of an equity market hedge. But late in the day Friday, as we go out, it looks like the equity markets are going to close on a little bit of an uptick. Obviously, a lot of money got bearish in the last couple of months with the war breaking out. It's getting chased back into the market. Maybe a little bit of quarter end rebalancing next week. But oh my God, after that, do you want to be bullish on equities? We'll see what earnings period brings, but we're hearing more and more from companies that margin pressures are coming. That to me is the bigger risk at this point. So with that in mind, what's our bull bear pick of the week? I think you got to favor some bonds over stocks here for a trade. Listen, bonds are terrible investment here. But we are getting to the point with the US 10-year pushing 250 and the US long bond above 250 that we're starting to get some attractive levels from a tactical asset allocation perspective in terms of a hedge, in terms of a place to hide, while equities go through their convulsions as the hawkish central bank does damage with QT and aggressive rate hikes over the coming quarters. So, you know, put that long bond on your radar. I've hated it for months and months and months, and now I think we got to look at it again. Have a great week, everyone.